interviewing the leading private equity executives and unlocking the secrets of success. Welcome to the Private Equity Podcast with Alex Rawlings.
Hello, everybody. Joining us today is Reynir Indahl, Managing Partner, Founder of Summa Equity. Welcome and thank you very much for sharing your insights into the private equity industry with us today.
Well, thank you very much for having me.
Perfect. So Reynir joins us from Norway, but his firm's both got offices in Stockholm and in Oslo. So for those who haven't heard of you or listened to the numerous bits and pieces you've put out with articles, podcasts, everything that you've shared during your career, just give us a kind of a 30 or 60 to 90 second breakdown of yourself, please.
Well, that is a challenge in 90 seconds, but yeah, so I started up Summa Equity in 2016. We were the first fund to commit to the UN Sustainable Development Goals. And we're a thematic private equity firm. So we invest within resource efficiency, changing demographics, and tech-enabled businesses. So these three areas are really aligned with environmental, social, and governance, so ESG. So we target companies that are solving some of our global challenges. And for us, if we can measure that and screen that according to the 17 UN Sustainable Development Goals, for us, it's not a problem we're solving. So we're in the mid-cap private equity space, focusing on the Nordic, but in some of the areas, we are looking at deals really globally now, and build up a portfolio of 14 companies. So that's where we are managing around 1.5 billion euros. I often get the question of why going on this path, and 2016 is not that long ago, but the world has really changed quite a bit in these 5 years. So we had some of the leading mainstream LPs in our funds. But I did get a lot of questions around our sustainability focus and the alignment with the SDGs and also our thematic ESG aligned focus. The reason why I started Summa was after the financial crisis. So I've been in private equity for quite a long time. I was also in McKinsey before that, and I ran a tech company for 3 years that I took public. But the financial crisis really changed a little bit of my outlook. I didn't learn that at school or in any of the jobs I've had that the financial crisis would come. So obviously I started digging into why did it come, and also understanding more of how the implications of our system on our ecological degradation and climate change, and also social inequality. So became increasingly worried about where the world was heading. So at some point, I looked myself in the mirror and asked myself if I was part of the solution or part of the problem. And I was sitting there with a pretty broad private equity portfolio, including some oil and gas companies and other companies. I didn't feel that I really had made a choice regarding becoming a part of the solution to our challenges. So that's why I decided to leave the private equity industry, started working with philanthropy, and then I started working with impact investing. And it was through that journey where I really saw that some of the best companies growing tremendously are those that are solving some of the challenges that we have. So that's why I decided to form a strategy around it and build Summa.
Perfect. No, I really like your header. It's not ESG, it's not sustainability, it is solving global challenges, and I do like that as a headline. If it was a branding company that came up with that, then well done to them. If it was you guys, then even more impressive.
It was actually us, so we
right?
didn't. Yeah.
Excellent.
Yeah.
So it's very clear, and I think it's really differentiating as well, because I think a lot of people chase the sustainability, and I know there's been recent how would I call it? Recent legislation put in that is therefore changing how sustainability has to come into private equity, and no doubt you'll know a lot more about that than I do. But I think that gives you a really clear kind of mandate, not only for your LPs, but also I think it's driven from your LPs, and that was going to be one of my questions. It's being driven from you, and wanting to make those changes in the world that we see now. So, well, let's delve into that. So, you mentioned about the focus on that. What are your goals for the firm that are linked to that? You know, that global change, that solving those challenges.
So there are a few things that we measure across the portfolio, and we're focusing on CO2 footprint, obviously, and the ecological degradation. Also on the employment that we create, and also diversity. So, but other than that, when it's linked to the SDGs, it's really specific per company, because each of them are solving a different challenges, although we do have some overlapping companies. So what we try to do is, first of all, when we meet the company, when we screen it, we're very focused on what challenge is this company solving, and do they have a leading solution for solving that challenge? Because we want to invest in winners. So once we sort of go into some, we're quite problem focused when we're searching for a company to buy. So within each of our themes, we have a priority of these. This year we will focus on this problem, and then we have a good group of people which have a background in understanding those challenges and the industries and the companies that are part of it. So take waste and recycling. So our waste is a huge problem, both from a resource standpoint and from a CO2 climate change standpoint. So once we sort of target that, then we are looking for which are the best companies to buy. And then, so it's part of a screening criteria. So for a recycling company, obviously, we are looking then at what's material to their business and how they're solving this challenge. It's both, you know, how much ton of waste do they actually process? Is it real processing, or is they just moving the waste from one place and dumping it in a landfill? So what's the actual recycling rate, both the material recycling and the energy recycling rate? And how much net CO2 is saved by doing that? And how much of the resources are recovered? So that's how we go about linking, and I can go through each of our areas in this fashion. So it's very specific on what problem that company is solving, but we have always started with the problem definition. And if you look in our reporting, we link those KPIs to the reporting that we do, but also the financial plan and the strategic plan. So when we make the strategy plan for the company together with the management team, it ends up with a business case and a financial case, and all private equity firms do that. But as a main driver, it also have to drive the KPIs. So for our waste and recycling companies, for example, they have to show that they can increase the recycling rate and also process more waste. So they are growing, and that's feeding into their bottom line. So that's very much how we go about doing it.
How would you? And that's interesting, because I think there'd be a misconception, I hope, that within sustainability and those good investments, that maybe they don't align well with what we regard as typical private equity returns. And as much as this is great, that you're investing in these types of businesses, how do you ensure that the businesses you invest in give the kind of returns that bring the next fund, and the right LPs? How do you get that kind of aligned?
So it's what we're doing is really embedding this into the strategic and business case for the company. So, and that you have to have a business case and a financial plan that you believe in. That's really where our base case is driven from. As it is integrated, and we are very much focusing growing the companies, and in that way solving the challenge better, and also upgrade along the way how they are solving that challenge to improve. So what we have said since the start is that this is a new way of creating higher returns. So our approach is creating superior returns. It's not a trade-off between sustainability and your financial return. So we've written an article called Private Equity 4.0 for the Journal of Applied Corporate Finance, where we go through the phases that private equity has been through. So phase one was in the 80s with the barbarians at the gate and financial engineering, where private equity bought large, it was the KKRs, bought large conglomerates, broke them up, put a lot of debt on them, and incentivized management to create value. And then more and more private equity shops were started, and you had to do something new in order to drive further value, because there weren't that many conglomerates left, and so everyone was doing financial engineering. So in the 80s and 90s, it was a lot of focus on margin improvements instead. So private equity firms added operating partners. You had the Toyota production system, lean manufacturing, Kanban, all of these tools. So it was a lot of focus on margin improvement. So private equity 2.0. Then in around the turn of the century, the private equity firms started to be quite many and started to compete with strategic buyers, but didn't have the same synergies. So you saw a lot of the private equity firms become large global institutions with industry teams, and also finding way to get value across the portfolio, whether that was on purchasing or better sales or whatnot. So that was sort of the institutionalization of private equity, sort of 3.0. What was different from what we call 4.0 is now you have to integrate sustainability and ESG into the value creation. If not, you're going to underperform on returns. Why? Well, the reason is it's really about what kind of externalities a company makes. So so what kind of impact do you have on society, either environmentally or socially? And what's the cost to society of that? Those externality costs didn't really matter during private equity 1.0 up to 3.0. It didn't hit your P&L. It didn't hurt your valuation of your companies. So it had very little effect on return, and that has changed. So I think, in a world that is as troubled and volatile and have issues that we have, these externalities are going to be moved onto the P&L. So CO2 is going to be taxed. It's already been done that now in Norway and in several countries. Also, people, especially the younger people, care much about working for a company that has a meaning and a purpose. They want to be part of the solution. So if you're going to attract the best talent for your portfolio companies or for the private equity firms, you need to integrate this way of thinking as well. And now LPs care about it. So if you're going to raise the money, you will need to have a strategy around ESG and sustainability. And for us, as a value driver, first of all, it has helped us source the companies, since we are quite thematically focused and we know what we're looking for. And we have a story around why we are knocking on your door and why we would be a good owner. And we have developed a methodology for how to drive the growth in the companies in order to do this. So it's a long answer to your question, but I can take one specific example, which we just announced. So Sortera, which is one of the largest waste and recycling companies in Sweden, it was one of our first investments. The company, so we owned it for nearly 5 years. We now sold it to Nordic Capital, who's going to continue the growth journey that we had. We made over 8 times the money on that investment. The IRR was over 80%. The company has now more EBITDA than revenues when we bought it 5 years ago. And we haven't put any new equity into it along the way. So this has been organic, as part of it has been through add-ons, which have been debt financed. But the whole strategy plan was driven based on our sustainability focus, where we were looking at how can we grow this company and how can we upgrade what they're doing in the recycling space, and how can we show society and also attract the best employees in how we're solving some challenges and what kind of positive externalities the company has created. So Sortera, across any industry in Sweden and any company, was voted the 11th most sustainable company in Sweden. And IKEA is on that list and a few other companies. So, and this was purely driven by our embedding sustainability into the growth strategy and driving the value creation. And that's why the exit multiple was nearly twice our entry multiple on it as well, because the market recognizes that this is a future-proof strategy. This company will continue to grow. It has the future in front of it. So that's just one example of how this is really driving superior returns in our industry.
Excellent. A good example of you've been able to get a return with it and adding those additional X's, probably because of that sustainability and future of the business. So that definitely quashes the misconception of this model not sitting certainly with private equity and obviously Nordic Capital, albeit that I'm sure they will have now a sustainability program that they're rolling out.
They were very focused on it. So I think private equity is waking up to this, and it is the best place to start, because we are majority owners of our companies, so we can be an instrumental part of how to drive the value creation, the strategy in the company. So I think more and more private equity firms are starting to understand that this could be a material driver for the value creation.
Excellent. So looking at, obviously you worked in private equity, you kind of came away looking for something more down the philanthropy route and looking at different options. You mentioned you looked at impact investing. Why set up your own private equity firm? Why go through all the stress and strain of raising funds and everything else that comes with it and establishing Summa?
What would the alternative be?
I'm sure there's a lot of people listening who've come up with a lot of other ideas. Although, holistically, I think they'd like to have that. But what was it that drove you to, okay, I'm going to found my own firm. I'm not going to go and work for anyone else. There's nobody that fits the criteria.
Well, I don't think I am a typical entrepreneur. So I probably would have joined if there was another Summa out there, but there wasn't. And I really believed in this strategy, and this is what I wanted to do. I wasn't sure that this was going to be successful, or that I would be able to put together our first fund. But what was good is that I did have a couple of LPs who were strong backers and believed in the strategy. So that sort of helped us get started. And we did Sortera, which I mentioned, and one other deal prior to raising the fund, because we had backing on a deal by deal basis, and those sort of proved the strategy as well. So I decided to start Summa because there wasn't anyone else out there doing this.
Makes sense. And what are the biggest the biggest couple of challenges that you've faced with setting up your own private equity firm?
I think so from an LP standpoint, we have some of the leading mainstream LPs globally, and at that point they were purely return focused. So they didn't have a mandate that included, sustainability or. So it was the question that you also brought up, whether would this be a trade-off on returns? And so I had to spend considerable time explaining how the megatrends, how tailwind growth, give them examples of companies, why these companies would outgrow the general market, why they're more future-proof, how it's driving their margins, and how it would also drive their valuation. Although we never put into our base cases that the value multiple would go up. So, we would buy and sell at the same multiple. So the valuation would really be increased, would really be driven by the growth in the companies and the improvement. So I think that was the number one challenge initially, to really convince LPs that this was going to give them higher returns, not lower returns. The one way of convincing them is actually that we were, if they didn't get superior returns, we get a lower carry. So our carry goes down to 15% if we underperform on the return side. But then we get an upside, so we get more than 20% if we do well. And so far we are actually above our top end on returns. So that was from the LP side. On the deal side, my worry was a bit that, was the universe big enough? Because since we are thematically focused, would there be enough deals to do? I've been surprised positively that not only have we had a very strong pipeline of deals, but we have been the preferred buyer in 90% of our deals. So they have short-circuited auction processes. We have got exclusivity prior to the processes. They've only had one-to-ones with us. So, for companies, and especially founders selling the company or bringing on board a partner, to have an owner that is aligned with what you're doing and that's very purpose-driven and focusing on the core of the business and how to drive that and how that is providing positive benefits for society. That has been a very strong positive force on the sourcing side. So that wasn't really a challenge, but there was a concern I had.
Yeah, it's interesting. There's a podcast that isn't out yet, but it will be at the point when this goes out, with Oliver Gottschlag, who's an academic who studies private equity, runs his own firm. You may know of him. He spoke a lot about creating a private equity firm that knows its strengths, that knows what it plays in, and positioning itself. And you've just described exactly his kind of thoughts and beliefs. It comes down to, in essence, how I would see it as a business owner, branding, marketing. He saw it as that, look, let's get the fundamentals right. This is what we do. This is where we play. These are the returns we get from this, and being able to market that effectively. And it sounds like that's not only working from your LPs with that, probably the initial education piece, whereas now I'm sure it's a lot easier for you based on fund track record, but also the sustainability kind of word coming up a lot more from an LP perspective, but also sounds like you're attracting portfolio companies and getting through processes quicker and being the preferred private equity investor because of your beliefs and because of the model and because of what you're offering. Is that right?
Yeah. I would say it, yeah.
Interesting. It shows that kind of specific, and I think people fear going too niche and going too specialist, and that's why we have far too many generalists going up and down the small, mid, maybe not of the large cap end, but there's certainly too much of a broad focus there.
What's interesting, we started out with a Nordic focus because that's where we are and our track record are. But since we have been quite specialized in a few areas, we are seeing deals coming to us globally within those areas, and that's because we have a portfolio, we have built a brand and around it, and we do have domain knowledge in those areas. So it's quite interesting to see how as I said, I was concerned about how many deals there would be in this space in the Nordic. And suddenly you realize that the competences that you build and the understanding and the recognition, it makes us really global much faster within these sort of narrow areas where we really have become specialists and have a portfolio and knowledge.
Sounds like your ambition is not just to remain in the Nordics then. We'll be seeing Summa expand internationally from there as well.
Yeah, we've already done a few deals outside the Nordic, and we do have some of our principals, which are our operating partners and industrial advisors, now sitting globally within the areas that we focus deeply on.
Interesting. So you mentioned prior to Summa, you obviously spent time in McKinsey. You then spent time with as a chief exec. How have you found that change from running a business and being at the leadership end to now investing in companies? How was that transition?
I think it's quite. I think most private equity firms will confirm this, that in the end it is about the people. But I think very few people in the private equity industry, more so in the growth and VC part of the private equity spectrum, really have that much knowledge from operating a company and what that takes in order to drive and to build an organization and the culture. So what we are quite purpose driven as a firm, So very much thought into sort of what are our purpose, what are our values, how do we work as a team, how do we build the culture in Summa. And I think that differentiates us from other private equity firms, which have been less focused on creating that DNA and a value-driven, purpose-driven organization. Then on the portfolio side, that's the same. So there's a Harvard Business School case study on Summa and also how we work with creating purpose-driven organizations. So with all of our portfolio companies, if you can really get that flywheel going, where the organization all the way down, not only the board, becomes purpose-driven, and the organizations see that the strategic and operating decisions and that management walks the talk, and that this is really happening and believe in it, motivation goes up, innovation goes up, psychological safety goes up. So the performance of those companies are extraordinary. You know, we have, if you look through 2020, our portfolio, so we have, and all of them were affected by COVID-19 in some way or form. All of them came out of 2020 better than 2019. Despite that, you know, if you take Norsk Gjenvinning or Sortera, our two waste and recycling companies, the volumes fell because the business activity started up. But they outperformed on all levels in 2020 compared to 2019. So you see the huge difference when you have a purpose-driven, motivated organization, very much focused on the challenges and how to solve them and how to contribute, much more agile. And they're willing to take salary cuts across the board voluntarily in order to excel and improve. So it's I think it's something everyone knows in the private equity industry and will say, but I do think very, very few work on it. And that's why, you know, if you're going to be purpose driven, you have to figure out what your purpose is, and your purpose has to then to be anchored in something externally. It's not, you know, you can't create a purpose driven company among that, you know, we're going to make the most money in the world. That's not going to drive really the motivation in the organization. But if you can do something positive for society, whether you're a waste recycling company, a healthcare company, a tech company, it's a huge driver for performance.
Okay. And having worked on both sides of the table and the operational role first, what advice would you give to kind of PE professionals that are listening on how they can better engage and communicate with their portfolio executives?
I think what is quite important is to build an internal organization in the private equity firm that is quite diverse, and diverse not only on gender. Gender is quite important, but also from a background wise. So, and the way we work thematically with our principals, which comes from an operating background, how we sort of make them the chair in our companies, how we work. They sit with us and work 100%, up to 100% with us, and have the same economics as any on the investment partner side. You know, nearly half of our investment organizations are women. They see other things than men do, and culturally it makes, you know, the dynamics and how you work as a team and how you pull together different knowledge into the team quite differently. So I think, you know, the old approach coming a little bit from PE 1.0 and 2.0 with financial engineering and also the margin improvements and sort of very technical skills, that has changed in a knowledge society, and where everyone wants to have to work with something meaningful. You need to build a different organization, and most private equity firms that have been in the business for 20-30 years haven't made that shift yet, and I think that is quite necessary if they are going to work well with the portfolio companies and add value in a different way and help them see things and create performance on the organizational side.
Absolutely. And you mentioned kind of, you know, P 1.0, 2.0, 3.0. Where do you see the 4.0 as the ESG side, or do you see that differently?
Yeah.
What's your interpretation of 4.0?
So 4.0 is about how to integrate ESG into value creation and reducing risk. So an ESG, the whole framework is really about externalities. What kind of impact does a firm make on the environment, on socially, and how can a company be affected by externalities? Like the pandemic is an externality that's affecting all of us. So the G and the governance side, that's an area where private equity always have been good. So the private equity model is an excellent model when it comes to driving value and performance in companies. But it's the E and the S side where and the externalities where that hasn't been integrated before, and that's where it's a risk if you don't really think about the possibility that the pandemic will come. I mean, Bill Gates and others have warned about it for a long time. It's not like it was a black swan; it's a white swan, and it was fairly probable. None knew when it was coming, but why don't have a scenario where you sanity check your portfolio or investment if there is a pandemic or climate change? Have people started to do that? I mean, we have done it for 5 years, and I think some are starting to do it now and stress test their portfolio on it. Social inequality and the middle class disappearing. How will that affect your base cases in some of the retail industries, for example? So I think so for us, it's really about how do you drive the top line and value in the companies by integrating ESG and sustainability, but also how you mitigate risks and the downside by understanding fully the ESG risks embedded both externally and within the company. So that's where the 4.0 differentiates, is that you look at the externalities and you look at how that's going to affect your growth, the valuation of the company, and the risk in the company. And you make investment decision based on it, but you also do the value creation plan based on it, and you have mitigation plans based on it.
So aside from that kind of ESG and the ES, as you mentioned, so if we put that to one side, what one mistake, or what's the biggest mistake that you see kind of private equity firms are making? And I appreciate, you won't spend all your time studying it, but you come across as quite analytical. You've obviously put a lot of thought into Summa and no doubt analysed the market. What do you see as the kind of biggest mistake that PE firms are making aside from considering ESG?
I think it's the way they go about ESG. And ESG, ESG, the way I'm explaining it, is different from what others are when they explain what ESG is.
Okay.
So for most, at least until quite recently, ESG was a check the box approach. Make sure that the portfolio companies had the policies on child labor or whatever. So it was really focusing on much of a checklist, policies in place, make sure that you do the right thing. Private equity firms added people on the ESG risk officer. So they had some have an ESG department, and they create a lot of these frameworks and checklists, and they get in sort of specialists as part of the due diligence to do the checklist. We don't do that. So obviously, some core policies all of our companies have, but that's pretty standard and not a big deal. But it's really, we want our investment teams, we want our value creation teams to embed this in the strategic value creation agenda of the company, in the follow-up in the boards, and how we make decisions, how we drive operating decisions in our portfolio companies, and also thematically and what kind of firms we invest in. So for ESG, for us, it's not a separate entity. It's not a check the box approach. It's not an ESG person who sort of makes sure that all the deal team does the right thing. This is at the core of what we do on the investment side and on the value creation side.
Interesting. And looking at the private equity industry, what is it that you love about private equity? And equally, what is it you hate? And if hate's too much of a strong word, what do you dislike?
What I really like, I think, it's a fantastic ownership approach. I mean, we are close to the companies. We are active owners. We are aligned with the management teams. We have our focus on what kind of value we want to create. We're agile. So I think you've seen in every downturn, there's been this criticism that a lot of the returns in private equity is coming from that we have a lot of debt on the companies. So obviously the equity returns go up, but the risks go up then, right? But that's not what you see in the data. Yes, we do have higher leverage than a public listed company has. But you also see that the private equity owned companies overperform listed equities in downturns because of this agile set of operating, where we can make very fast decisions together with management. We can do the changes. We're close to the company. We drive the changes. So that's where I think the private equity model is a superior ownership model. So that's what I really like about private equity. What do I don't like about private equity? It's like then I'm probably generalizing a bit because I know a lot of the private equity firm. I think they all have some unique, fantastic features and great people. It's been a very sort of money-driven industry. It's been male-dominated, quite egocentric. So I don't, is it the best place? Is it the most fun places to work? You come into work every day and you feel like, I love all my, we are aligned on the values and what we're doing. It's a nice, good environment. It's high fives. Or is it a pissing contest? My deal is better than yours, and look at what I've achieved. So I think, and you find both spectrums there. And you probably do that in the corporate world. I've spent less time in the corporate world than in the private equity world. But I think that's, at least when I set out to start Summa, I wanted to have this new strategy around sustainability and ESG and to create value in that way. And I wanted to create a different firm. I wanted to create a firm where everyone just loves coming to work and where we bring our whole self to work and where we work as a team and where we help each other out. So a different type of culture and sort of value-based organization.
Awesome. And with obviously us being an executive search firm, talent is always on our minds. You mentioned it earlier about the people within the business. What are the kind of three attributes that you perceive make a top performing either portfolio executive, private equity professional, whichever you want to describe? Maybe both.
So for us, it's quite important that you're purpose driven and you have your values aligned with us. So I mean that's you can be fantastic in every other measure, but if that's not aligned with us, you're not part of Summa, nor will we hire you as this executive group or the board in any of our portfolio companies. On the investment side, I would say it's two things that are very important to us beyond that. One is to have high conviction. So, we want to look at a deal, we want to meet the management team, and we want to form an opinion quite quickly. Is this something that we would like to go all in and invest in? Or is this not exactly? Yeah. So we have to prioritize our time quite a lot. So if we run after every possibility that there is, we will not be able to make the best deals. So I am looking for individuals who have high conviction on things, and that conviction should be a good conviction. So obviously there's some factors below that as well. I would say the third thing is how do you connect with people? So what I tell our teams is that it's like a soccer match. You go out there to the match and you want to win the match. So what kind of match do we want to win? What's our soccer match? Well, our soccer match is the first management meeting. if we are not able to win over the people that they would like to work with us as owners, it would be a difficult journey. So I do want people that connect with people, that see people, that understand people, and that are givers, not takers, as Adam Grant has written a book called Giver and Taker. So I'm looking for people that wants to be at service. They want to help. And they have the ability to see the person on the other side and see what kind of struggles and how to help, and make that person feel that I'm here to help. I'm not your owner going to dictate what you're going to do, but I'm actually here to serve and help.
You mentioned a book there by Adam Grant. Where do you get your influences from? Reading, listening, watching. Where do you get your influences from?
Multiple sources, and I think through my own journey, where I sort of were digging into where our financial system was going, climate change, social inequality. I've been all over the place and gotten inspirations from that in leading up to the decisions that I made and Summa. So I would say over the 5, 6, 7 years, what has been very important to me is our cooperation with Professor George Serafeim and Rebecca Henderson at Harvard Business School. So Rebecca Henderson just came out with a book called Reimagining Capitalism, and Professor George Serafeim is coming out with his book soon. And the class they've had at Harvard is called Reimagining Capitalism. So Summa is a case study in it. Norsk Gjenvinning, one of our portfolio companies, is a case study in it. And that whole thinking that they have formulated is very much aligned, and Summa is partly based on it, and they have been advisors to us along the way. And Reimagining Capitalism is the most oversubscribed MBA class at Harvard. So the students have had quite demand of understanding how to change the world in a positive direction. So they have been very inspirational to me. I would also say Amy Edmondson, professor at Harvard as well, written the book Fearless Organizations, and how important psychological safety is and how that drives performance in companies, been very important. Also a French ex-McKinsey author, Lalou, which has written a book, Reinventing Organizations. It's also a quite fascinating book. And quite avant-garde, and Adam Grant at Wharton, which I referred to, also fantastic individual psychologist, written several good books, Originals, Give and Take, just came out with Think Again, which is a fantastic book. But he's also picked up on some what Lalou is saying in Reinventing Organizations about self-managed organizations. So how do you make teams be self-managed? And drive performance that way. So that has been quite inspirational in how to create sort of purpose-driven organizations and self-driven organizations. So those are a couple of the things I can think of right now.
There's quite a lot there, I think, for anybody to go away and research. If anybody wants to reach out to you after this conversation, maybe to go offline with regards to sustainability or whatever else from there, how best does anybody kind of reach out to you, Reynir, to have a conversation?
I'm on LinkedIn, so that's probably one place to start.
Perfect. We'll put your contact details in the show notes with all the details on that. Well, look, thank you very much for joining us, Reynir. I really appreciate your insight and really enjoyed this conversation.
Well, thank you. And I'm really happy about being here.
Absolutely. So, as always, thank you very much for those listening for joining us. And of course, should you ever need support, both with private equity professionals or your portfolio executive hiring, please do reach out to me at Raw Selection. Please do subscribe, and obviously you'll get notified of the next podcast. But till the next time, keep smashing it. Thank you very much.
Thank you for listening to the Private Equity Podcast on www.raw-selection.com.